Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Welcome to Real Estate Risk Report. This is Lance, and today I have with me David Scott with Silverado Funding, based here in the greater Portland, Oregon metropolitan area. How are you doing today, David?
I'm well, Lance. How are you, buddy?
Doing really good, really good. Thanks for joining us.
Thanks for having me.
Yeah, why don't you just share a little bit with us about Silverado, sort of the deals that you guys fund, just to give a little bit of context into what we'll be discussing today.
Sounds good. Yeah, thanks for having me. My company is Silverado Funding. We're a private money lender based here in Portland, Oregon. We've been in business since 2006. We do bridge loans. We do new construction spec loans to builders, and then we make loans to borrowers who acquire homes, fix them up, and sell them off. And as I said, we've been doing that since 2006. We're pretty small in terms of our capacity. We have about 15 million that we lend out. We try to do it like 1.5 times turn each year. We have a bank line of credit that's 4 million. We have a fund that's got 2.5, and the rest is our own cash. Got it.
So, when it comes to, let's just take sort of your right down the pipe, loan and borrower. I mean, what kind of deals are you hoping land on your desk? I mean, and how do you sort of, go about that process? Are you sort of like, hey, we're looking for really solid borrowers that'll be repeat guys, or, what sort of, how do you guys approach that in terms of, on the acquisition side, looking for new deals to originate?
We love repeat for sure. If you've gone through the process of vetting a borrower and then they just do one loan from you, it's like, okay, that was, as long as you got paid back, that's great. But if you can tee someone up to do, 1 or 2 or 3 loans a year, if you're a rehabber, that's really ideal, because it is pretty significant in terms of our process and due diligence and vetting.
Yeah. So let's talk about that. When you do have a new guy show up or gal show up that's looking to borrow money from you, what does that process look like? What do you put them through? Is there some sort of, application that they fill out, or, what does that mean when you say you're going to do diligence on the borrower?
Well, it's the 3 C's of lending. It's collateral, capacity, and character. So have you worked with the borrower before? Do you know them? Do they do what they say they're going to do? Do they have a good track record? That's the character component. You've got your collateral, obviously. The house that they're going to rehab, should it be torn down? Is their scope of work totally off? Is it great? And then you've got their capacity, how much cash they have, really. So you want to see the borrower's got the requisite downstroke, which is either 10 or 20% down. And that'll show us, are we going to charge them 10% interest, or 12, or 2 points for 6 months, or 3 points for a year, or, that'll, how much cash they're going to bring in and how much they have is going to show you how much you want to really charge in terms of points and rates. And you want to see they've got a backup too, in terms of paying interest. So if you've got a $100,000 rehab budget, you'd love to have your borrower have $100,000 in capacity.
So how do you confirm that they do? I mean, what do you do some kind of verification of funds, or what's that process look like?
Yeah, we do. I mean, we've got an application that we have our borrowers fill out. On that application, there's a question on there, a couple questions. Have you ever had bankruptcy? Have you ever had a foreclosure? Have you ever been convicted of a crime? You answer, no to any of those things, and then we pull a background report. It's a Thomson Reuters product called Clear. It puts the borrower's social security number and name through all the public databases, and it'll come back, oh yeah, they had a BK 2 years ago, but you didn't disclose it, or oh, you got convicted of a felony 3 years ago for fraud, so bye-bye. So, but if you disclose that, not the felony, but the BK, and there's a good reason for it, we could still work with that.
Yeah. And then do you call around and talk to other people about these guys, or do you look at their, past projects or any of that kind of stuff?
Sure. We want to see a track record. I definitely go out to the project and meet the borrower out there, shake the hand, look them in the eye. We do get last year's tax returns. I really would just want to know if they filed taxes, or if there's a big loss, why. Uncle Sam's the man that can stand in front of us in terms of a payoff. So if you didn't pay your taxes, we're not going to lend you money. And you'd be surprised how many people are like, oh, I just didn't file in 2017 or 18
Right.
this year. And you're like, oh, okay, so we can't do that. And then we get an account statement as well, just showing they've got some liquidity.
Got it. So then for most of them, will you allow someone to be in second behind your first, or is that
not as a rule of thumb? I do have 2 seconds on the books right now. One's for just a proven performer. He had a first that was owner finance that was at like 3.5%, and we didn't have the capacity to pay off the whole first, so I'm in second on that one. So occasionally we'll do seconds. We try not to, unless it makes a ton of sense, obviously. And then we do not allow a second. It is an event of default in terms of our docs. Occasionally a borrower will borrow a downstroke. We don't like to see that, but that's kind of the rule of thumb if a loan's larger. You know, in San Francisco, for example, if you're going to acquire a house for $2 million and rehab it for $700,000, 2.7 is your loan. You're going to have to bring in like 400,000. So your average contractor, as a borrower, it doesn't have 400,000, so they'll borrow that. So occasionally there'll be a second for that scenario, but we try to avoid that.
And then if, I suppose a lot of the loan is you've got a rehab situation, and so they're using, some of your funds for rehab. Do you guys like hold those funds back, and or how does that work? Like as they're completing the project, how do you ensure that the work's being done and those sorts of things?
We've got an inspector that we have that goes out to the property and has the scope of work in their hand, and meets the borrower prior to closing on the loan. And we'll say, the inspector will say, yeah, there's nothing here that's material that's missed, and if this is done in a workmanlike fashion, it should be good to go in terms of the pricing that's on there on the backside. But we prefer to lend the rehab money, and that's how we do draw number 1, like day number 2 of the loan. In terms of the rehab, is we have that same inspector go back out and say, okay, yeah, you're 17% complete or 29% complete or whatever the number is, and we'll disperse on reimbursement through the end of the loan.
Got it. So what, for you guys, if being in the Portland metro area primarily in terms of your collateral, if property values were to go backwards, how much exposure does that create for sort of, obviously this is any lender, any market, but just, how do you look at that sort of downside protection and because some of these guys, it's obviously they're basically repositioning the asset and then if they get stuck, now all of a sudden, the market's going backwards. Is that sort of what keeps you up at night? Is that
Sure.
That's the sort of thing it can get you?
That's what happened in 2009. I didn't take a paycheck for 18 months. That was a rough one. We were doing lots of stuff in the Midwest and the South where houses are like, they're fungible. They're like widgets. So that's not the case in the Portland market. We have an in-house broker who does a comparative market analysis for us on comps. We get a CMA from our borrower's broker as well. And then we also get an appraisal that usually is slower than our closing, but that allows us to either put it in our fund and have it capitalized that way, or bring it to the bank and borrow against it. So we try to maintain no more than 75 loan to value or LTV off the ARV or the after repair value. And then we're having the borrower bring in 10 or 20%. So we have about a 30 to 35% nice cushion there in terms of the house dropping in price. And the rehab loans are on the books an average of 6 months. And the new construction spec is 9 to 10. So you'd have to have a 30% drop in that shorter period of time in terms of what we thought the house was worth. We do not loan to own at all. I do not want to take a property back.
Yeah.
It happens every couple of years.
Yeah. So it's really, from a market standpoint, given where Portland's at, it's probably a pretty stable market even throughout as you go out. So it seems to me then the execution risk is probably the biggest thing for you, is just that borrower's ability to kind of execute the plan.
Absolutely. And that's why we prefer to lend the rehab, so we can monitor the process. Every lender's got a different, kind of recipe. And some do not lend rehab and just it's all on the borrower, and they're not even really monitoring that because they're like, hey, I've got 20% down and I've lent you at 60% of what I think it's worth. So if I can take it back, great. But we're not that way.
So yeah, get into that a little bit more. So those are sort of the things that others can do that are maybe more dangerous. So you're saying that in that case, instead of holding back the rehab, they just basically advance the entire amount.
No,
or no,
they don't touch the rehab at all. They verify that the borrower's got that much cash to rehab it themselves.
Okay.
So just everyone's got their little wrinkle on it.
Right. So is there any, without naming names, I mean, is there stuff that you see in the market that just terrifies you as a lender that other lenders might be doing that?
Oh, no, lenders that don't pull tax returns. I mean, that just kind of blows me away. Or you could lend to someone that's got a tax lien on them. So when we pull that clear report, it'll say if they've got a tax lien. Yeah, I owe the state of Oregon, $79,000 from 2018, but I'm working on it. I'm like, wait, you don't pay taxes? Like, I mean, if you're on a payment plan and it makes sense, maybe, but yeah, that kind of makes me, that would keep me up at night, knowing that half of my loans on my books had borrowers that had tax issues, or because I hadn't pulled, a pretty basic report that would tell me these things about this person.
It's mainly because they can come in and take those proceeds ahead of you. Is that the...
Well, a wise man once told me all borrowers are liars, right? So everyone's going to lie to you in some capacity. So is it just puffing and I've just said, hey, I've done 6 deals, but I've really only done 2? Or is it like, yeah, I paid my taxes, no problem, and I've never paid them? So then everyone's going to try to pull the wool over your eyes as a lender in some way. So just how do you mitigate that? And that's, you stick to your due diligence process that you put in place over a long period of time.
So like you mentioned, you guys had come up sort of through that last, downturn, and you kind of had a front row seat to it. I know that that's when you started to sort of get more into this, being an attorney by training and those sorts of things. So is there any sort of, really juicy stories of just stuff that you saw in that last time that left a big enough scar? What's like the one that you wish you could have taken back, or that you had a front row seat to, that was just gnarly?
We had a mortgage company that was doing some exit loans for us as a takeout from our loans in Washington. We had some office space. They were renting from us. My phone rang one day and there was nothing on there, but it was ringing. It was like no caller ID or anything. I'm like, oh, who's this? And they're like, hello, Mr. Scott. This is Agent Johnson from the United States Secret Service. We found a bunch of tax returns in an office building that your LLC owns, and we just want to let you know that we're going to dispose of them because they were here incorrectly. So it was just a mortgage company that just shut up shop in the middle of the night and just left all their files there. So we didn't even know about it. So I was like, oh my God. So we helped them secure it all and shred it and everything. But that was a good one. We had the FBI get involved with the nefarious borrower and promoter on the ground in Jackson, Mississippi, way back in the day. And that was like, oh, geez, this guy's now under investigation from the FBI, and we lent him a little bit of money. I cannot do that anymore. So that's why we're in Oregon and Washington now. So we've had some tough ones. Let's
yeah. So it sounds to me like that the things that you saw then kind of have caused you to retreat, focus on where you're at geographically, stick to sort of the like you said, the eyeball tests, and trust but verify pretty much everything, and assume that you're being lied to at every turn.
Yeah, pretty much. I mean, that's it. I mean, you don't want it to that mentality or mindset to make you callous or just think everyone's terrible in the world. Yeah. But when lending someone money, you need to kind of keep that in mind. So.
Yeah. So when you're dealing, since you do have a pooled investment fund and an open-ended vehicle, what is the typical objection or the biggest concern that your prospective investors have about the fund? What's what is the thing that they're seem to be most concerned about from your point of view?
The thing that I would think comes up is just the lockup period. So in terms of the PPM, we have the private placement memorandum. It's got a 24-month lockup period after your investment's made, and that's a big one. Like, ooh, really? I'm gonna invest $100,000. And we need to make sure that you're accredited and your portfolio is spread out so that that's not your only $100,000, right? And you can put that in. But that's kind of the biggest knock that I've seen. And for us, and while the document says that, if you invested your 100 and then, in 9 months, you needed it back for a family emergency or something like that, I'd work with you on that. So
right.
That's probably the biggest objection.
Yeah. So so are many of these, it's maybe they're coming from where they had the sole assignment on a loan or something where they're used to, hey, I basically invest in this one loan and it's going to pay off in 7 months or whatever it is. And is that sort of, then they go, well, I like 7 months better than 24 months.
Yeah. I mean, if so for me as an investor, I would not want to be linked up to that loan, because if that loan goes awry, then I'll obviously, if I put the deal together, I'm going to figure out how to get the money back. But then I'm locked up with that. If you're in a pooled blind fund and you're just a member of the LLC and you have an ownership interest in that, and if one goes south, and we'll work it out, and I'll probably pay it off and pop it in my holding company until I work it out. But it's transparent to the investors so that you don't have that risk of 123 Main Street going awry and having your cash locked up to that.
Yeah. Yeah. That's one of the things too with these. I mean, these debt funds are great because of the diversification and, and obviously the degree that they're in first position. And like you said, you don't got tax liens and, any other sort of stuff that could jeopardize your position. But it seems that is, I've heard some of that sort of situations where maybe like title issues where someone's able to borrow money, twice, from two different parties. And I mean, I suppose that's what so you guys get title insurance on every deal. Every deal. Yeah. I've only had to have you utilize it once. And it was because the title company was supposed to get a subordination agreement, a release of a lien. It didn't get released. They thought it did. They gave us a clear title report. We went to foreclose 18 months later. And of course, this was the one that had an issue on it. And when we pulled the title report to foreclose, that lien of $250,000 was supposed to be released, was never released, nor was it subordinated. So it's in front of us. But it was Stewart Title, and they, to their credit, they stepped up and they paid for our attorneys, and I think they paid $250,000, and it was $1 million lien. We got the $1 million back, minus a little bit. But we had $1 million that wasn't working. It wasn't in our fund. Yeah. It wasn't working for like 720 days. It was so painful. It's the opportunity cost of that. We could have sued the title company under Oregon law for the loss of that fund, for those funds. There's one piece of case law on that. But I just figured, hey, those guys have stepped up and they paid for our attorneys. So let's just let it go. Yeah. I mean, it really is. It's sort of that's the title issues and seem like those are the ones that can bite you. The other being, property insurance, monitoring and making sure that they have that. I mean, how do you guys ensure that? I mean, obviously at closing you are, but, ensuring that the policy doesn't lapse. Are you being written into the policy as a, yes. Yeah. We're written into the insurance policy as the mortgagee and the mortgagee clause. And then we're also monitoring that. So we'll get notification if that lapses, and we'll put it onto our forced place insurance so that and forced place insurance is more expensive. So I'll call the borrower right away, or someone from the office will, and just say, hey, you let the insurance lapse. And they'll be like, oh yeah, I did. Okay, sorry. And then it's good. Or it's like, oh yeah, no, I didn't. And they're full of it. So you're like, okay, this is a problematic loan all of a sudden, because you let your insurance lapse, which is not a big component of cost in terms of the loan. So. Yeah. Yeah. And that's just it too, is if you are in, obviously it's all good if you're dealing with good people, but, back to that sort of assignment stuff too, is that, someone can fund a loan. And if you've got the ability to assign that loan to, I mean, you kind of mentioned it at times, obviously you're assigning it from your warehouse to the fund or, whatever, and that's all good to make sure that the right parties, assigned, but it also means that you're dealing with sort of a lender who might not be as upright, their ability to, if they control the vehicle that has the assignment, to assign it to some other entity. It's all of those title issues that you really have to look out for, right? That that can make it difficult, and I just think those are things that investors especially don't necessarily you're not thinking about that. You're thinking, oh, this is great. You're the bank, but the bank can also do what the bank wants to do. And if you're dealing with a bad bank, it could be bad for you, or someone who's not following the things. I mean, it's administrative burden for sure. I mean, tracking the forced placement or the insurance and, making sure that you've got it in place. The borrower thinks, oh yeah, my bad, no big deal. And you're thinking, oh my gosh, if that place burned down, like we would have been toast.
Right. Literally.
Right. Because you can't, at that point you can't, without having that mechanism of the forced place and the monitoring, you can't do it retroactively, right?
You can't. You can do it retroactively during the month. I think you can put it in. If you find out in the third week of the month, you can go back to the start of the month.
Yeah. So, like that, so the big things you hear and the takeaways from this, right, is just like you said, you've got an inspector, someone who's going out there and making sure the work's being done, third party who does that. And before you guys release the money, obviously title insurance, ensuring that you're monitoring the insurance, those are really the ways that one can, short of just making bad loans. Of course, that's the, just doing dumb deals is, could get you before any of those things. But
even the game is key in terms of the borrower, because if you've either borrowed or you got 20% of your own cash into a deal, you're less likely to walk from it than if you've got 5 or 10 and all of a sudden the market corrected. It's like, what? I don't want to walk away from this, but now that I've got no equity there, so.
Yeah, so making sure that they've got actual skin in the game is the big one. So, well, it's great. It's good to kind of catch up and kind of hear from down at the level maybe that doesn't get asked. That's why I asked the question about what are investors asking you about, and it's it's like they're more concerned about when can I get my money back?
What's the return? I'm like, it's 10.8 since inception. They're like, that's it? I'm like, that's a pretty good return. There's no debt in our fund, right? So if you could go out as the operator or the promoter and get debt in your fund, and then your return would be 14, 15, 16%. Great. But I for about a year of my life, I smoked in college, and every time I talked to my mom, she'd go, and she'd say bye. And so I finally just quit smoking just because she would do that. So now when I talk to her, she's an investor both in Silverado and in the fund. She goes, no debt in the fund. Click.
Yeah, no debt in the fund.
No debt.
No, because that's the other. That's
Silverado,
the other,
but not in the fund. So.
That's right. Yeah, that is the killer. The killer is you put leverage at the fund level. Those parties generally are, they're going to want their money back if anything happens, and
they get it first.
Yeah, and you're not. Definitely. 20
markets, let's say, and like, okay, and there's a reason why the guy in Detroit's not using, or that could be a bad example. The guy in Birmingham's not using the local hard money lender. It's because the deal's not great or the guy's nefarious. So, I'll call D. Scott in Portland because he doesn't really know. And you could have all your things in place to mitigate those risks, but if she's got a bad actor because you're so far away, then how do you deal with that asset when it comes back? So that's why we're just working in Washington.
Yeah,
and we just got our license in Utah.
Yeah, well, there you go. So you're expanding a bit, but you actually, you guys don't you have a house out in Utah?
Well, we do. Mm-hmm.
Yeah. No, that's good stuff. So, well, I appreciate your time, David. You have a great week, and we'll be in touch.
Thanks, Lance.
All right, take care, man.